Welcome back to It's the Economy. Well, there is a bunch of economic data out in the United States. The private payrolls, ADP payrolls, have come in at a measly 37,000. Market was expecting 60,000. And separately, the PMI numbers have also gone into contraction terrain. Because of that, we have seen moving down of bond yields a bit to 4.36 from the 4.5% mark. But on a larger scale, the bond markets are terribly worried about the big, beautiful bill, now called, of course, an abomination by Tesla's chief, Elon Musk. Nevertheless, that bill is likely to determine the distaste or the, affection for US bonds by the global investors. And that can, of course, determine how smart money moves and where it moves. To discuss this entire range of yields, rates, currencies, I have with me someone who has followed it for a very long time, Neeraj Seth, founder and chief investment officer at 3R Investment Management. Thank you very much, Neeraj, for coming over to our studio.
Thanks a lot for having me here. It's a pleasure.
And all of you guys must have seen Neeraj in his previous avatar at BlackRock, where he managed fixed income for the Asia-Pac region. Okay, Neeraj, my first question is with this big, beautiful bill, which has already passed the House. But now the news is coming out that it is likely to punish OECD investors, foreign investors who hold US bonds. They may be taxed. So do you see that if that goes through, the yields can go to what, 5%?
Well, first of all, if that goes through, it will be really bad for the US fixed income markets. Now, at this point, there's some level of ambiguity around it. And if you look at the projections with regards to what they're expecting from these taxes, it's pretty low, which clearly is not taking a broad-based approach. The key here is if I take a step back and think about what's going on in the US, you have to look at anything coming out of the White House from two different lenses and see where it fits. Okay. One is the fiscal financing, like trying to cut taxes, raise revenues, and trying to get that balance. The second is the whole negotiation tools around the tariffs. To me, the 899, the way it sounds with the ambiguity around it, it's more of a negotiation tool. Obviously, as you said, it's focused more on Europe, UK, Canada, a few countries where President Trump wants to put more pressure. But I can't see this going in the direction of taxing all of the fixed income. It's going to be very punitive for the domestic markets and steepen the yield curve further.
Oh, yes. Now, let us assume for argument's sake that 899 doesn't happen. As you say, that's perhaps more a negotiation tool than a way to draw money into the fisc. What about the broader bill? It is a bill of tax cuts, and that is the core of the bill. That will not go away. Any which way you do the math, the Congress Budget Office has clearly indicated that it is higher fiscal deficit for the foreseeable future and going on rising for the next 10 years. So what happens to the US bond yields?
I think that's a 36 trillion question, given how big the market is now and how much it's growing. There's still north of 2 trillion of fiscal financing required, the net issuance for this year. I think there's a fundamental issue around the fiscal discipline or lack of that at this point and the consolidation path. And the only way I can see that's changing is the bond markets pushing everybody in the corner by, sometimes when you see the moves. So if you see the 10-year and the 30-year treasuries again selling off, that'll put some pressure. But for now, to your point, the direction of travel is certainly more fiscal financing, higher debt to GDP in the foreseeable future, which is not good for the economy.
No, my pointed question is, at the moment, at 4.4 to 4.5, which the bond yields have been at that average from the day Trump was elected, is that factoring in this big, beautiful bill, at least the tax cuts and the expenditure? Or if that actually passes, it'll have to factor.
I don't think it's fully factoring in at this point the extent of the impact of the tax cuts on the financing requirements. Obviously, the markets move in a more probabilistic weighted way. It got through the House. Expectation is goes through the Senate. As it gets closer to the time for the Senate to vote on it, I do think the bond markets will actually show some signs of pushback. So I don't think we have seen that whole pricing in of the bill in the markets as yet.
Okay. Now, the reason why we're doing all this is to get you back to Asia. If the bond yields in the US look set to remain high, and more generally not very pleasing for investors, we are finding Japanese yields also rising, right? I mean, they're at whatever, highest since 2008, even after falling from 1.5%. Now, where does this leave bond investors? We saw a goodish amount of FPI money coming into India because of index inclusion. Will we see more of it? How will smart money move?
So I still believe that from a fixed income standpoint, the smart money moves in the direction of the positive real yields and the fiscal discipline. If I take those two together, India is a great candidate for investors to still look at, given where the inflation data is coming in a 3% handle and the policy rate is still sitting at 6, which will change tomorrow in my view. But the direction of travel is clear that you potentially will see more flows going in the higher quality, moderately yielding emerging markets. The other element which you didn't touch on, and I do believe it will become a factor as we look forward, is what happens to the dollar. So if dollar sees further consolidation, your case for good quality emerging markets with lower correlation to the US monetary policy actually becomes a tailwind.
Okay. No, actually, you just took away my next question. I was going to come from yields to the currency, and maybe I should have asked you that before we speak about smart money. The dollar, where do you see it? At the moment, at near 6-week lows, about 98.8 is the dollar index. Do you see it moving towards 90? Is there a lot of depreciation waiting to happen?
So currency is always very hard to predict. But if I look through the history last maybe 6 decades, there have been 3 regimes of weaker dollar. It was in 70s, 80s, and then 2001 to 2008. It didn't mean that US economy didn't do well during that period, but dollar did weaken, which was again a tailwind for a lot of emerging markets. Even last big one was 2001 to 2008. I remember it was a golden period for India. I actually think we might have entered a similar regime where dollar has to go more in terms of the weakening. And part of it is not just the fundamental story, it's also how the capital flows move. And with the global investors owning close to 25% of the treasury market, bond market, a big chunk of the US equities, as the reallocation of capital happens, and if you do have all these Section 899, the tariff uncertainties, you name it, all of that what's coming out of the White House, I expect that to actually keep the pressure on both the fundamentals as well as the capital flows, keeping the dollar on the weaker side on a consolidation phase for the next few years.
So what does that mean for the rupee? Because there is another moving part over here, what the yuan does. I mean, we do have our eyes fixed on dollar, but we're always looking over the shoulder and don't want to appreciate versus the yuan too much.
Well, you would see potentially rupee to be in a more stable scenario. You also have the RBI on the other side trying to manage, obviously, the volatility of the currency, if not the level, and in return collecting more dollars as the reserves for the country, which is not necessarily a bad thing, creating a bit more stable macroeconomic environment. So on a dollar INR front, I'm more in the camp that you see sideways to even in case of depreciation, a lot less depreciation than what people factor in and what they have experienced over the last 2 or 3 decades.
Okay. All right. So a repeat of the 2001, 2008
Potentially,
period,
yes.
as you pointed out. Okay. Therefore, do you expect smart money to come to Indian equities as well?
So Indian equities, I still think longer term, it's a good place to be. If you look at the world right now, I do think US story continues with regards to innovation, growth, shareholder returns, the focus on the whole return on equity. I think that's going to continue. It's not going away. But when I look outside of the US, the only large economy with a secular growth story is India. And given the performance of the markets, I don't see how that changes in terms of the capital flow. So I do expect the capital flows to stay. Obviously, there's always a tactical element when the markets are expensive. What we saw last year in September, Nifty crossing 26,000, and we saw some outflows. But in a longer horizon, I think the long-term flows will continue towards India.
Okay, yeah, there is the longer-term story, both in bonds and in equity. But I can't let you go without asking you, towards the policy. What do you think is the terminal rate in this cycle? Are you expecting 2 more rate cuts? That's what our poll threw up. But there are quite a lot of people who expect the repo to go to 5/4, and SBI expects even 5%, which means 4 cuts. what would you say, that much of an interest rate differential contraction is possible between India and US?
I do think so. And part of it, what obviously is important here, there are two core factors from a global perspective and the domestic macroeconomic standpoint. From a global perspective, when you think about the US tariffs and the potential impact of that on the rest of the world will be actually left with some excess capacity if the US economy slows down because of the tariffs. That will have a disinflationary impact on the rest of the world, including India. Second, coming back to the India story, which I find really fascinating, we always look at history, but the countries go from developing to developed country only once in the cycle. Yes. And the infrastructure built, the overall structural drop in inflation only happens once. So I'm more in the camp that you'll see more than what market is expecting from a rate cut perspective in the next 2-3 years and a lower terminal rate. So I'll be more in the 5% camp than 5.5%.
Oh, that's an excellent takeaway from this conversation. I'm sorry we're out of time and we have to conclude. But, the big takeaway which Neeraj is telling us, and as a long-term viewer of many markets, we have to take this very seriously. There is a reset of Indian macros, which he is hinting at and which is going to attract way more funds. That's a very big positive in terms of India's journey from a developing to a developed country. Many moving parts in the US bond yield story, and the yield at 4.5 is not factoring in all the contents of the big beautiful bill. And finally, smart money likely to chase Indian stocks and bonds given the state of rival markets. Very, very important takeaways from this conversation. Wrap up on Bazaar on that note. Chartbusters coming up after the break.